Good morning, everyone. It's Hump Day, Wednesday, September 24th, and we're going to talk about stocks on this live stream. I think we've got some interesting content for you. Daryl's going to go through an evaluation on the charts of the SPX. We're going to lead off with that. And I've got a list of stocks that members have sent my way, starting with Bruker, and already I've done evaluation on Bruker, and I wanted to dive deep into it. And we're coming off a day when we saw the index as a whole sell off. And it's mainly because these big valuable companies, NVIDIA, Amazon, Tesla, Meta, and some others sold off. And there was other areas like energy did really well. I know a couple members did well yesterday because they were in energy, they were in aerospace. Aerospace did well. So it was a day for the contrarians yesterday. Is it going to continue to sell off? Well, the markets were heading up in the pre-market when I last looked, but just a slight bit. So it's not. I'm not sure that we're going to have a rally today. I'm not sure we're going to sell off today. So we'll have to just give it a few hours, and then we'll figure out what the market's going to do today. I wouldn't, I'll kind of give you my high-level comments, and then I'm going to turn it over to Daryl. And by the way, how you doing this morning, Daryl?
I'm doing wonderful, Victor. It's good to be here. Good to see you. Hello, everyone.
It's great to see you as well. I look forward to seeing your analysis. But just high level, I feel like we're in an expensive market. No big, surprise there, right? The chairman of the Federal Reserve, he was quoted as saying that he felt the stocks were expensive as well. Shouldn't be a big shock. So if we have just a good sell-off, that wouldn't be bad. It wouldn't be bad at all, especially some stocks are just really, really high. And some of the stocks that I own are really expensive. So I think if we had a little sell-off, it wouldn't be a big deal. It'd be a little bit like taking the medicine, preventive medicine, so to speak. So those are just some initial comments. I wanted to turn the screen over to Daryl. I know he wanted to cover the SPX, and the screen is yours, sir.
Yeah, so I was asked about this yesterday in the Discord and never got a chance to answer directly. But after I did a little bit of research, I thought I would just share it in the live stream for everyone, because we have had some comments about where's the seasonality been for September and a few other questions. So I thought it'd be a good idea to just take a look at it and see where we are. So this is a chart that I drew back at the end of August during one of our live streams. We were talking about seasonality. So if we look at it here, September was expected to be down about 1.2%, 46% of the time. It is not higher than it opened. So that is not the case at all this month. And then October, November, and December are typically all positive months. So that was a chart that we were looking at the time. And then I drew this auto resistance line here, the red one, and then it turns green when the price gets above it. So this was set to the February 19th high around 61.44. We broke out above that on about the 27th of June, and we really haven't looked back, with the exception of the first day of August, which was down, and then I think the first day of September, or the first trading day, was down, and that's been about the extent of the seasonality so far, because it's just been up and to the right since that point. This purple bar here is sitting over the price by volume bars with the highest amount of volume for purchases. So what I saw is a lot of support in this range. And if we had a breakdown, which it doesn't look like we're going to have now, but if we had a breakdown I would have expected support in this range. So anyway, where are we, 6 weeks, 8 weeks later? Is we're trading above a 20-day, we're trading above a 50-day. The 200-day is moving into that price by volume bar range, but I don't think this is going to be in play. I also drew or added these Bollinger Bands. Those put a band around the 20-day moving average of 2 standard deviations, where if you're familiar with statistics, 95% of the observations would fall within 2 standard deviations on a normal distribution bell curve. When you start getting to the extremes of that distribution, then the probability of it going higher is only probably about 5%. So we got a pretty low probability for, a lot higher here in the short term. And we do have a potential for a reasonable pullback, which I'm thinking would be probably no more than the 20-day moving average, which is only 2% away.
And that's because we're toward the upper limit of that Bollinger Band. We're
Yes.
kind of at that high point. So we have room to fall, but not much room to rise.
From a statistical probability view, that's what I'm alluding to.
Okay.
So we are coming out of an overbought condition. And I also added a panel down here for the CBOE put call ratio for equities. And when you see a very high value like this means that the put call ratio is 73 for puts,
Mm-hmm.
and calls would be very low. So people are buying insurance when the put call ratio is this high. When you start getting as low as we are at this point, I put my crosshairs right at that point we are today. There's only been 2 points over the past year where we've been lower than that.
And for some reason, I'm seeing your arrow over, is it June 2025 or July?
Yeah. Yeah. So
There we go.
Okay.
There we go.
I only see 2 points that are below that. What this means is people are not buying insurance. They're not buying puts. They're actually buying calls, which means people are somewhat
bullish
bullish that this is going to go up some more. But from a statistical point of view, if we come outside of these Bollinger Bands like we did here when we
So the
fell below
statistics are
them.
telling you we could have a pullback. We could have stock prices go down. Trader investor behavior is telling you we could rise because they're optimistic, they're bullish.
I would phrase it as they are probably complacent right now.
Investors are complacent.
It's been going up for 3 months,
Uh-huh.
and they've gotten somewhat complacent here. Because from a statistical point of view, the odds are not in their favor, and they're not protecting themselves right now.
Okay.
This is a bit of complacency. Whenever you see it this low, just look up here and look what happened. A little bit of a pullback. It got low, we had a pullback. It got low, we had a pullback. It's minor, not very big, but it was probably 2%. Here was probably 2 to 3%. So this is all I'm looking for, is probably just a 2 or 3% pullback, which would get us back to the 20. I'm expecting that
Now,
over the short
I have a
term.
question on your Bollinger Bands, right? So going back to March, April, we did have substantial sell-offs then, and the band really expands
Yes.
And now we've been going up really nicely, which when the waters are calm is when I get the most nervous.
Yeah, the
I'm like, okay.
volatility is much less here than it was here. So that's why the Bollinger Bands
Mhm.
Bollinger Bands look back for 20 days. They look back 20 days and look at the
Yeah.
volatility, and they calculate the standard deviation based on the volatility over the last 20 days. So as they get narrower and narrower, that means you have less and less volatility.
Yeah. Okay.
So I'm not
Interesting.
expecting anything drastic. I'm only expecting 2 or 3%, but I am expecting that
I
fairly
agree with
shortly.
you that if we don't have any big news, like a big news event could, torpedo the stock market, but that's nobody can control that, so to speak. Um, I agree with you that, like I was saying earlier, the market's just expensive. If we take a little medicine, hey, just some stocks, are getting a little overheated. So let's pull over and let it cool off a little bit. That's all I'm talking about is, maybe a 5% pullback and then we're good.
Yeah. Let me share a couple of other things.
And just real quick, Malt Licky, Texas, I see your request, and Regeneron is going to be the second stock we're going to cover.
So this is from FactSet. They analyze the earnings expectations for companies, and based on their earnings for the next year, they're expecting the S&P to actually rise up to 73.38, which is a 9.6% increase over the monthly or Monday's close over the next 12 months. I tend to agree with them here, which I'll explain here in just a moment why. And then they shared this as well. This will be publicly available on Friday. I got a preview of it from another podcast that are partners with FactSet. So here's the layout of where they expect, based on earnings over the next year, what sectors they expect to do the best with the target close. So I
Wow, this
found,
is really interesting. So
yeah,
you're
so
going to
I
go
found,
over. Uh-huh.
yeah, I found this somewhat interesting as well. I believe that real estate is going to do pretty well for quite a while.
Mm-hmm.
It's taken a lot longer than I expected, but I knew something like this had to happen, and I'm glad to see that on the chart.
Mm-hmm. Yeah, I'm surprised that energy is number one, because energy is driven, speaking about oil, it's driven through uh, the price of oil per barrel. And, but I understand like other components of energy are in higher demand due to electricity demand. So that's interesting that energy was listed number one, staples number two. Yeah, I could see that as well.
This
They've
would
been
be a far cry from what we've been seeing.
Well, it's almost like technology, communication services, financials have flourished so well that how much more upside is left? The
Yeah.
PEs are really high, the valuations are really stretched. Whereas with energy and consumer staples, some of them, and I would say a good portion of them, are priced really well. So if they catch any kind of good news, it's really going to rally. Or if anything, investors might rotate into those sectors to diversify.
So I'll be keeping an eye on this. It's pretty interesting. And one thing that could drive energy prices is just uh, demand.
Mhm.
So based on the GDP now, which we talked about, last Thursday or Friday, they're expecting GDP above 3. I think the Fed is expecting a GDP of 1.6. Both of them are showing growth. The Fed is a little more less optimistic than the Atlanta Fed is right now. The next time this will be updated is Friday when the PCE comes out. So we'll see, based on PCE, whether we see a rise or a fall in the GDP estimate. And then one last chart I wanted to show real quick is the offense versus defense. This one here. So this looks at the QQQ versus the SPY, the XLY versus XLP, which is discretionary versus staples. And then the last 3 panels are just growth versus value in the large cap, medium cap, and small cap. And what we saw basically through the month of September towards the end of August, after a decline in the QQQ in relation to the S&P 500, it was declining. We saw that reverse in September. And then the sell-off yesterday, we actually saw it go back down. But since September, it's definitely been risk on. Discretionary versus staples, the risk on. Growth versus value in the large cap, somewhat interesting that it's been declining with just a very modest rise. Mid cap been pretty much flat, but look at small caps.
Yeah, I've seen that.
Yeah, they've really taken off here.
Great work, Daryl.
And we did have the sell-off yesterday, but we've definitely been in a risk-on configuration.
Very interesting. Thank you.
Okay, I'm done.
I
was going to take a look at the VIX.
Yeah, go for it.
An idea.
I was going to just reflect and say, I hear you present it, and in some cases, I'm like, I totally agree. Like small caps, totally agree with the data, but the other data points lead me to kind of think, oh, okay, I kind of see some of it. Hasn't been as obvious as like the small cap rally, but really interesting stuff.
Yeah. So the VIX is moving back up while the S&P is also moving back up. That doesn't happen very often. So that's another reason that I'm thinking that we might be in for a small 2 or 3% pullback here in the
But the VIX seems super low. I mean,
it is pretty low. I have a dotted line here at 20. That's usually what I keep my eye on. If it gets above that, then people are starting to get really fearful. They don't appear too fearful. But what's interesting is the S&P is rising and fear is also increasing, albeit modestly at this point.
Okay.
So anyway, I'm done. Here we go. Hopefully that answered.
That was good stuff to get started. Thank you very much. Very interesting. So we're going to get into the stock analysis segment of our stream now. We're going to start with Bruker, and then we're going to move to Regeneron. We're going to be in the healthcare space. And according to Daryl's data, it's the 3rd best sector going forward. Number 1, energy. Number 2 was staples. And I think healthcare is number 3. But let's be specific about one company. This is Bruker. They do med devices. So within the medical industry, you're going to need workstations. You're going to need this equipment to do the sciences of discovering drugs, maybe analyzing a patient's body or laboratory results and so forth. So that's what they do as a company, as a business. This company is a $5 billion market cap company with revenues of $3.44 billion. They are profitable. PE is really high this year. The stock has not been doing great. It's especially the 1 year. This thing has gotten priced less than half of its high in the last 52 weeks. So investors have moved away from this stock. I've completed evaluation. I'll show that to you in a few minutes. Now, this business is growing. The growth has been good for 4+ years. They had a contracting year in 2020. Understandably, we had COVID and it disrupted a lot of industries, this one being one of them. I'm sure that hospitals had to kind of slam on the brakes and say, okay, we got to go from normal operations to a pandemic situation. So I think that's what disrupted that year. So that is not their fault. As we look at their profitability and free cash flow, let's take a look at that. So they have decent profitability. It's not excellent. Like United Therapeutics is a stock that did really well yesterday. They have like 80% margins, and that type of business, they don't require a lot of capital to grow, where Bruker does. They manufacture something. They make a thing. They need to buy materials. They need to hire people to make the product, assemble the product, and so forth. So the margins, to me, the higher the margins, the more desirable. The lower the margins, the less desirable, because they really show up on your profit line. You see how they've really been struggling with profitability, which coincides with their stock price. Their stock price has really been selling off. Well, here it is. Here's the profit. The investor is being rational in this case. The company is not making a lot of money. Investors are not liking the results. They went from double-digit profitability down to low single-digit. Not good. So that's rational what investors are doing. The free cash flow is also hitting a low point. And the low cash flow has caused me to, instead of taking the trailing 12 months, which I did when I did my evaluation this morning, I'm actually going to take a 4-year average, because I think they're going to revert back to a higher number. And if I took this number, it's just way too low. Now, so profits are down, cash flows are down, stock price is down. That's all rational in my mind. Let's take a look at their balance sheet. And this is an important step just to know what kind of risk are we dealing with here. And this company does have some debt. Remember, it was about a $5 billion market cap company, and they have $2.48 billion of debt with a little bit of cash. So it's mostly debt on the balance sheet. When we go debt to EBITDA, 4.44. This is above my preferences. The limit's 3. It's above that limit. So it's like, okay, your profits are down, cash flows are down, your debt is a little high. All these things are not good. So let's carry on. So we have a balance sheet that is a little sick, needs a little tending to. They need to pay off some debt, maybe start cranking up the EBITDA. Analysts cover the stock, and they really focus on earnings per share, and they think it's 50% discounted. Now, earnings per share, Charlie Munger, he's come up because in the news because he picked BYD for Berkshire Hathaway, and it did really well. He hated earnings per share because he felt that management can really manipulate this number. I partially agree with Charlie. Charlie was like a purist. He was also at times a little cynical. And with earnings per share, I agree it could be influenced by management, but also gives you a scorecard that most investors will refer to. So that's why I always look at it. I trust earning free cash flows. That's 66% of my evaluation when we get there. But I look at earnings per share. And earnings per share actually give you a more positive picture on this business. So on this company, I would agree with Charlie Munger that, hey, the earnings per share doesn't reflect what's going on with this business well enough. I would agree with him because this number looks somewhat good. PE ratio of 14 looks good. They've been growing at 10%. So if I only used earnings per share, I'd probably arrive at a positive conclusion on Bruker. But you saw that I saw some pieces that I didn't like with free cash flow, net profitability, and then that balance sheet. So that's why I look at all these things and make sure that I take it all in, make a more holistic evaluation and then decision on a stock. So here's Bruker, and I'm going to change the discount rate. We have a balance sheet that is not good. It's a domestic company, so I'm going to change it to 9.5. That makes the stock a little more expensive. Let me do that over again. We're at 41. When we change the discount rate, because this is a riskier company, I'm taking a higher risk. I want a higher rate of return. And it changes the net present value of the cash flows that I'm forecasting and brings that down the value. I also take away the debt level from the value because, hey, they got all this debt on the balance sheet. It really reduces down the equity value to 1.48 billion. Their market cap's 5 billion. So unless cash flows really change and the debt level changes, these guys are in for a long-term, low stock price. If you look at the free cash flow value of Bruker, the earnings per share value, again, it shows somewhat of a positive number. So on this one here, Bruker is a sell for me. It's not a good investment for me. And I oftentimes find myself with med device. I always fall short on valuations because they have lower margins. And they're in the same industry as a Novo Nordisk, as a United Therapeutics, as these pharmaceutical companies that have these tremendous margins. And I oftentimes look at these companies and think, no, not investable. So this evaluation was recommended or nominated by Kane. And that's my analysis on Bruker. The next one we're going to talk about is Regeneron. And it's a interesting stock that has come up on live streams quite a bit. Regeneron gets a lot of attention. So let's focus in on Regeneron and see what's going on with this stock. And I think, you know what I forgot to do, and I apologize. I'm going to back up a little bit. I didn't give you a minute to go over Bruker charts. Could you please do that?
Yeah. So I'm going to step way back here so we can include the COVID low, and that's where Bruker is currently trading. From a dividend perspective, they looks like they pay a low dividend, 0.6% yield, and they don't grow that very often. So this doesn't look good even from a dividend perspective. If we just go out to a year, we can see they've been on a pretty steep decline, and even for any upside here, you're going to have some stranded longs from about 42 down to 39. So I see that. Besides the 50-day moving average, if it moves up above that, you're going to find some resistance at between 39 and 43 or so. So that's my take on the chart. Doesn't look very good.
And somebody on the stream, Ben 10, said that a super investor owns Bruker. You are correct. Michael Burry. And Michael Burry, FYI, he has the education of a doctor. He's like a medical doctor. And he's, also a big successful stock investor. So he bought into Bruker. Now, Burry hasn't been doing great. And he's made some investments that I shook my head. I was like, what? Like, his big position was into a cosmetics company, Estee Lauder, and that one has not been a good thing. So he's in Estee Lauder, Lululemon, and then he's in Regeneron. Look at that. We're going to cover Regeneron next. Mercado Libre, which I'm into, and then United Healthcare. So this guy really makes some unique investments. I think he's great. He's the big short star. But anyway, he's the only super investor into Bruker. So thanks for bringing that up, Ben 10. So that's the analysis on Bruker. Let's move over to Regeneron. So Regeneron is a pharmaceuticals company. They discover, invent, develop, manufacture, and commercialize medicines for treating various diseases. Okay, so they're biotech, healthcare, pharmaceutical. And here's their website. Okay. All right, so we're dealing with a pharmaceutical, which I'm well versed in. I've been an investor in pharmaceutical for a long time. And these guys are a $58.88 billion market cap company. Revenues $14 billion. And dividend, they pay a 0.62% dividend. It's pretty low. PE ratio is nice and low at 14.3. Analysts think it is discounted. Year to date, it's down 20%. 1 year, it's down 50%. So this stock really went up and it really came down. This is like the Matterhorn, mountain. It has a really nice peak and it really is falling down. Is this stock, really discounted? Let's take a look. So they had really good growth rate back in 2021, in 2020. And let me think back. Did these guys have I forgot the term you use, but it's basically a medicine or a drug you take if you caught COVID, and it really controls the growth of the virus inside your body. I think they had some type of drug in that place, or that for that purpose. And then once COVID got under control, they kind of lost those revenues. Now they've been growing at a mid-single digit rate. The quarterly, they had 3 good quarters in Q2 of 24, 3 Q4 of 2024, and then they had a contracting quarter and an expanding quarter. So this year they're pretty flat, this year being 2025. So growth is to be determined. They may not be growing at this time. And I'm seeing other companies like Pfizer. Pfizer's having a hard time getting some growth going. And Pfizer just announced an acquisition of a weight loss drug company. And that's not going to help them grow for a couple of years, by the way. But that's an aside, just showing that some of these pharmaceutical companies get to a certain size and then they have a hard time growing. Regeneron is pretty good size, 14 billion. If you don't grow, your valuation is very different. If you're growing very quickly, your valuation you get a premium valuation. A lot of things, the numbers just look fantastic. If you're a slow grower, not so much, but we're going to look at that in a little bit when we get to the valuation. So we got slow growth, no growth, free cash flow. Free cash flow looks good. 3.8 billion. That's a pretty good number. Now they haven't been growing it. Again, COVID really throws numbers out of whack because you had a unnatural, only going to happen every 100 years number. So I kind of take that number and throw it out. I would kind of throw out these two numbers and say, okay, this isn't going to happen again. But if I compare before COVID to where they're at now, cash flows actually grew quite well. So that looks good. We have gross margins, which are lower than a typical pharmaceutical company. I think there's more into their manufacturing process and what they do. Maybe some of their drugs are more generic level, and they're not the beautiful 85% margins that you see some pharmaceutical companies have. So these low margins, I commented this on Bruker. This really kind of sets the table for how profitable a company is going to be. Even though they have these low gross margins, they have really high profit margins, which is impressive. So that looks really good, 31%. Free cash flow margin looks really good. So these two numbers are impressive, okay? And the free cash flow looks really good. Let me make a few notes here. And actually, I'm going to give you the screen for the chart so I can come back and take notes later. So free cash flow look good. It's a slow growth, no growth company. Let's take a peek at their balance sheet, see what we've got there. We've got a company with more cash than debt. And that is always a good thing, every single time. So we don't need to worry about debt because they don't have any debt. They have lots of cash. What are analysts saying? We got 23 analysts stating an opinion on Regeneron. One analyst is, hey, you're going to double your money. Another analyst is like, hey, it's priced fairly. That's not bad downside. Risk, very good upside, if you believe those analysts. So let's take a look at their forecast. Now, if this forecast is correct and they start growing, this would be very positive. As mentioned, they're going to be flat this year. So the market's maybe waiting to see if they can prove that they're going to start growing, which would be rational. That would make sense, okay? Now, I'm going to take 2026 numbers. They have an earnings per share number of $42 per share. That is expanding by about 5.5%. Their PE ratios are really low. These look good. All right, so that looks, their numbers, I'm going to update my valuation on them. And why don't I give you the screen? You can take a look at the charts, and then I'll start working on the valuation.
Okay. So the 200-day moving average has been declining for quite some time, and it's almost reached where the company is currently trading. That'll be a point of resistance to the upside that it'll have to break through. Yesterday, it came down and tested the 50-day, which is upward sloping. And today it's moving off of that 50-day moving average. The 20-day rolled over a bit yesterday and is now declining. So I do see several points of resistance that it's going to have to overcome to start moving back to the upside. The RSI is in negative territory at the moment. Looks to be flat over the last 2 days. PPO looks to have a crossover yesterday to the downside after moving into positive territory maybe a week and a half or so ago. The accumulation, it's been in distribution pretty much the entire year. They did have a small short-term money flow after the COVID announcements. They did go positive, but the price pretty much stayed flat for that entire time. But they've spent probably 85% of their time in negative money flow over the past year. And based on what we're seeing, we can tell that it's underperformed the S&P 500 by 52%, underperformed healthcare sector by 39%, underperformed the biotech at 39%, and the biotech industry is underperforming the SPY by 21%. So they've got some work to do to prove themselves here. They're definitely struggling at the moment.
Yeah, interesting. So my evaluation of Regeneron, I had all the numbers were on the free cash flow were still the same. I did change my discount rate. I had them at 9%, but I changed it to 8%, and growth rates of 4% on cash flow, and it produces a nice discount, 40%. And then the earnings per share number, I'm giving them an 18, because if they do start to grow mid single digit, their profitability, that looks really good. So overall, this is a discounted stock, 37%. And if you're an investor and you look at Regeneron and you think, I believe they're going to start growing, is kind of like your thesis, your best estimation of how their business is going to do. This isn't a bad idea. This stock was flying high, and it was partially because they did have a drug or a treatment during COVID that came in and saved the day, and a lot of people were buying it. But those days are over. We're not going to have that kind of activity any longer. So this one here, it's your call. Healthcare is priced, I would say it's still discounted, and it's in some cases priced quite attractively. Here's Jazz Pharmaceutical, Novo Nordisk discounted at 34%. United Therapeutics discounted at 19%. This thing's been flying up. So you have a lot of stocks within healthcare that are pretty good ideas. And, looking at the analysis that Daryl provided, which was kind of high level, some economic data, or at least some reports that he showed, that healthcare is a sector that's likely going to do well. Regeneron should be a beneficiary of that. The way the stock's been setting up, it's really sold off, right? And this, if it's a healthy business, if they do start growing and they have that profitability and free cash flow, this is setting up to be a nice winner. It could really start to catch a rally and double in value, because it's reached a nice stock price in the past. So that's the analysis on Regeneron. Thank you for asking. Thank you for sponsoring that. Maltlicky, Texas. Is that a city, Maltlicky? Or is that just like a fun name that you created? Anyway, something that happened in Texas is OpenAI. I saw a news story that the data center in Abilene, Texas, that they're going to use was opened. And it's going to be the biggest data center for AI in the world. It's going to be in Abilene, Texas. It just opened. All right. So Mike, the dividend investor guy. So he was really tuning into your analysis earlier, Daryl, and he thinks the Meta may fall. That might be the case, but I'm holding Meta long. Maybe I have a rough 12 months, but I think I'm going to have a great 12 years. So I'm keeping Meta. All right. So Ben 10, thanks for weighing in. Good comments. You had a lot of value. Thank you, sir. Peyton, Baba is blasting off. Houston, we're observing a celestial body. We think it's man-made. It's Alibaba Group going up 7%. And these guys have been flying up this year, 107%. I think the news is that we're back in the .com bubble days. Companies, their stock prices would rally when they would say things like, "Hey, we're spending a lot of money. We're really accelerating the amount of money we're spending," and their stocks would go up because the market was like, "Oh, they must be spending it on good stuff." And I'm seeing some of that behavior, which is, "Hey, we're going to spend more money on the data center," and boom, their stock price goes up. Geez. Let's make sure they're spending it wisely. I'm a Baba investor. So, but they're doing really well today. Good to see that. Up 7%. The stock, was way up here. I was at $300 a share. This was one of Charlie Munger's big bets, and this stock really surprised him. I think the world surprised him, that the world of investors, when you look at the strategic opportunity for Alibaba, right? They are the Amazon to China, to Asia. They're providing e-commerce, they're providing some financial services, and now they're providing AI, just like Amazon. Amazon has AWS, the number one hyperscaler, providing a lot of cloud services that includes AI services. So Alibaba strategically can be the Amazon for Asia. And I think Charlie Munger felt that way. I feel that way. And the stock really sold off, and it had a hard time ever grabbing a good number of investors to buy into the stock. But things have changed. It's really turned around. I think the economy in China has turned around. No more COVID-related shutdowns in China. And these guys have a very good position in the AI race in Asia. So there's a huge population in Asia, and a lot of businesses in the Middle East, in Europe, in India, they're picking Alibaba as their cloud infrastructure partner because it's less expensive. You're talking about compute, you're talking about infrastructure, and whether it runs in China or if it runs in Abilene, Texas, it's gonna be infrastructure. So a lot of businesses are picking the least cost region to run their workloads, and Alibaba is got a really, really strong future. So that's what's going on in Alibaba land. I'll show you this business. Their fundamentals are good. PE is still 19, even though this is a strategic business. Their growth, single digit, because they're big. They have profitability, free cash flows. And rather than cruising around here, I'm just going to go to the forecast and then go to my valuation. We have 13 analysts covering the stock, and there's probably a couple of analysts that are not believing in Alibaba. A couple of analysts believe in it, but are not overly enthusiastic. So they think the stock's fairly priced based on earnings per share. The growth rate is going to be good for a company their size. And they're going to expand profits really, really well in this fiscal year, which is a year away. When I look at the value of Alibaba, I still see a 10% discount. This stock's been going up and up, and it's, it feels good, frankly, because a year ago, I kind of felt a little foolish because I would put up that Alibaba's discounted by 60%. Alibaba's discounted by 70%. It felt a little foolish. And now it's like, okay, all right, good. I've been vindicated, and I've made a lot of money on Alibaba. So beautiful. Love it when a plan comes together. So it's still discounted by 10%, and it's a good company. I'm not buying any more shares because I own a lot of it. I'm buying Amazon because I think Amazon is being doubted and sold off. But I am happy to pick up Amazon shares, and I'm happy to keep my Alibaba shares long and be in Charlie Munger's camp on Alibaba. What do you think of Alibaba, Daryl?
So we're early in the trading day. So on this 7% jump, I am seeing sellers stepping in. We're only 21 minutes, but this candle pattern here tells me that some sellers are coming in. I can also see that with the distribution line, it is coming down and the money flow is coming down. So there's some sellers that are taking advantage of this 7.4% pop. They are trading above a 20-day upward sloping, 50-day upward sloping, and 200-day upward sloping, and they're in the correct order, which is good news. They are overbought at the moment. They don't stay overbought for more than a month or 3 weeks at a time. They have been oversold several times, but right now I think the probabilities are to come back down, maybe $10 a share or so. I think I don't think this rise today is going to hold, but they're not far away from their fair value according to Victor, so that doesn't surprise me there. Then I can also see the PPO is starting to roll over. Today it's moving back up a little bit, but the momentum for this run here was much stronger than the pattern that we're seeing here. It hasn't, looks like it's going to peak out maybe a little sooner.
Interesting. Yeah. Well, the news, I mean, it's just a news story, but the market really got excited about it. And again, hey, we're going to spend more money. And the stock goes up. Okay. Spend more money, Alibaba. Anyway, so great to see you, Tomas. Thanks for tuning in for a while, and have a really good day today. All right, so let's take a peek at the market. We've got a couple more stocks to go. So looking at the market, we've got some winners, some losers. Let's go over the winners. So we've got a couple of semiconductor stocks doing well. Intel, Texas Instruments, JP Morgan. The financials are up nicely. Tesla's up really well. Energy is up again. Look at the staples here. We're going to cover Costco tomorrow afternoon in detail, and they're up today. One of the big caps in consumer staples. Walmart is up. United Healthcare is doing okay today. Medical distribution's doing okay. But some stocks are down. Google is down. Apple down. Broadcom down. Micron is down. And this is a stock that announced earnings yesterday, I think after the market closed. And if you wouldn't mind, can we take a look at Micron and see what's going on over with that semiconductor company? I think I already have a page waiting for me here. So Micron is a semiconductor company, and I've covered it a few times, and they do memory and storage. And the one thing that, we always got to understand the business and not automatically put them in the same category as everybody else in semiconductor. For example, NVIDIA produces like 75%, 80% gross margins. Micron doesn't, and you're going to see that in their financials. So keep that in mind. Let's get into it. 1 year, up 74%. Stocks really worked. So it's looking good. 93% year to date. And it's really growth driven. The build out in data center, they need a lot of this memory and storage that Micron sells, and they have two other competitors, Hynix and Samsung, I think are their two competitors. Market cap 182 billion, and their P ratio is 21. Forward P looks really low at 9.95. Strong buy, but close to fairly priced because the stock's been really going up in price. So can't argue with that. The growth is what is exciting the market. This is really, really good growth. Most definitely excellent growth. And now this is where this company, I separate from like the really profitable companies. See, here's the gross margin. And you see how it's been a little bit mixed. Like here, they had a rough year in 2023, and their stock price really shows that. And their gross margin has improved, but it's nowhere near what NVIDIA produces, even Broadcom or others. Qualcomm is way up there on gross margins. Their profit is good because they're just cranking out the product right now and just shipping it out to customers. But I would, in my mind, this is when the build out of AI data centers slows down. That's when this stock's going to have trouble. The free cash flow margin is really low, so we have a low cash margin, cash flow, and the market's selling it off a little bit. But again, it's having a terrific year, so I don't think it's that bad of news. Let's take a look at their balance sheet, see if they have excessive debt. And I don't think they do. They have $15 billion of debt, $10 billion of cash. When we look at their debt to EBITDA ratio, it's less than 1. So it's actually a quality balance sheet. Not perfect, but good. So that looks good. Let's take a look at what analysts are saying. 31 analysts cover it. Lots of analysts covering it. And you see how some analysts are probably looking at those margins saying, hey, these guys, they're having a good year, but not sure this is going to be a long-lasting stock. At least their stock price isn't going to stay high for a long time. And some analysts are like, no way, man. We're going to the top. So it's a very spread out price target range. The current year we're in is this year. Looks like this year just ended. And they just reported on it. They grew quite nicely, and they're going to keep growing this year, 35%. But you see this slowdown's coming. And the way the market, the way investors tend to invest is 1 year forward. So this is the year that we just started. It started on August 29th, 2025. We're less than a month into it. And they're going to continue to grow this year. So their earnings are probably going to come out and be positive. But in 4 quarters, it's going to slow down. And this slowdown, I think, is going to be a kind of a bucket of ice cold water on the stock because it's not going to be a grower anymore. I think those low gross margins are going to show up. And that would be a concern for me. So while I update my valuation, you want to show the charts on Micron?
You bet. So it looks like they had their last previous high in June of last year. And then they sold off and pretty much traded sideways from July all the way to April. Then we had the tariff announcements. And since then, they've been on quite a run. They did have quite a bit of consolidation here for 2.5 months. They are trading above an upward rising 20, 50, and 200, and they're all in the correct order. So we do have a breakout above that June of last year's high at about 154, 156. They're actually down a bit today, 2.2%. The 5-day is also upward moving, but it is starting to lose a little bit of momentum. They were oversold going into earnings, and it looks like they're going to come out of the oversold condition probably here in the next couple of days. They did reach a peak on the PPO for the last, I'm looking at 3 years. Let me move down to just 1 year. A little easier to see the details. So they did reach a peak in the PPO, but it is turning over. And if that continues, they'll have a bearish crossover in bullish territory. Their accumulation was at a 52-week high about 4 days ago. It has been declining since that point, as is the money flow. They have outperformed the S&P 500 by 49%. the technology sector by 38%, the semiconductor industry by 21%, and the semiconductor industry is outperforming the S&P 500 by 23%. So my inclination is this price where it's been trading at for the last week is probably a peak for now.
Interesting. So you made a statement earlier that I wanted to understand. You said that it's been oversold and today it's down, so there's selling. And then the next thing you said was that should resolve itself. Can you explain that a little further? I would have thought if it was oversold to begin with, and then you have a down day, then it's going to be oversold even worse.
It's overbought right now. If I said oversold, that was a mistake. It's overbought, and it looks like any downward continuation of prices, which it looks like it's set up to do here. It looks like we probably had our peak 1, 2, 3, 4, 5 days ago. Because the PPOs roll. So it's going to resolve the oversold condition probably here in the next few days.
Okay. All right. So, all right, let me show my valuation on Micron. So Micron is, I think, priced too high, and the stock's flourished. It's really up there in market cap, but the cash flows are just not high enough. When you look at semiconductor, if you look at NVIDIA, really high free cash flows, Qualcomm, high free cash flows, Micron, low free cash flows. And it's like, whoa, what gives? It's those low margins. These guys are in the memory business, and it's very competitive there. It's very, they don't have pricing power. It's not like NVIDIA. They're like, hey, we only have 25% of the units that are being demanded right now. So they can get a really good price on their GPUs. Micron is not in that luxurious spot. They're more like, hey, we just need to get volume out the door. Now, the earnings per share looks pretty good, but I trust this number more. I put 66% of my weight on this number. And therefore, I think Micron's priced 32% too high. And I think what scares me as well on this company is if you look at their forecast, once you hit this slowdown, I think it's going to be ugly. So I would really, if I was a Micron stockholder, I would define my exit strategy, and I would determine at what point do I get out, because it could get really ugly. Like you lose half of your current stock price over the next 2-3 years. And you look at their profitability, it's supposed to go down substantially. So this is not looking good down the road. I think there's time to put a good exit strategy in place and figure out what you want to do. Because semiconductor is cyclical. You have ups, downs, and you want to make sure your exit strategy is organized so you don't ride the downs, you just ride the ups. If you're good at it, you'll time them with effectiveness. So that is Micron. The stock is trading down 2%. This is they announced earnings yesterday after the market closed. We'll see where that settles down later. All right. So are there any stocks you wanted to cover, Daryl?
I wouldn't mind taking a quick look at Tesla, because we talked about that.
All right. Let's take a walk on the wild side with Tesla.
So I have been a shareholder in the past and moved out, and then right now I am in, and it's basically, I can probably go to an actual chart where I drew the inverse head and shoulders or cup and handle. So, yeah, I drew them here. So in 2024, we formed a cup and handle. And when you measure from the rim of this cup down to the bottom, it's about 45%. And if you measure up 45%, we would have gotten to about 373, and it actually surpassed that price. It went up to 488. So using this cup and handle as a pattern, I spotted another cup and handle back in March and April. And if we measure down to the bottom of this, it's 36%. And if we add that to the price at this rim, we'd get to about 530, I believe. I'm actually looking for the price to get it to about 488 for when I step out with only 10 shares. But I'm actually riding this up, and so far, I think I shared this 2 weeks ago that I was entering this trade, and so far it's actually worked out, even though we're trading a little bit sideways here the last few days. We still are on an upward trajectory.
Interesting.
So that was one I wanted to look at. This is just a trade for me. And then just to take a quick look at Costco, because they report tomorrow. They are in negative territory on the RSI. So they're below the midpoint. And they also have a PPO that's in bearish territory. So they are showing some relative weakness as they move into their earnings tomorrow. I can look at past earnings. I think one of the past three, they actually went up. And two of the three, they actually went down after earnings. So I'm not sure I know what to expect. Costco is very well managed, but the market overall has been very offensive, and Costco is in a defensive sector. So I'm not sure I know what to expect tomorrow, but I just wanted to share that as we move into the earnings tomorrow.
Yeah, it'll be interesting to see their earnings. I'm gonna take a look at Tesla from a fundamental perspective, and just a spoiler alert: the valuation is going to be terrible on Tesla.
Yep, this is definitely a technical trade.
Yeah, market cap of 1.45 trillion, and you're paying 15 times revenue. PE is 259. Whew. This isn't, some people believe this is a tech company. I think they are, but they happen to also sell a lot of cars and a lot of energy, solar energy generation. The revenues are declining, and they're seeing a lot of competition globally within the EV market, especially coming out of China. China is coming on strong, and so are all the legacy car manufacturers. From General Motors is really going big with EVs. You got Volkswagen, you've got Honda, Toyota is coming on strong, Nissan and Honda are going to merge. So you have a lot of competition that isn't going to go away. They want to survive, and they want to, be a player in EVs. So Tesla's profits, their revenues are not going to be good. And Elon Musk came out and said, "Hey, we're going to have some horrible quarters." He's already put it out there. If you think this is bad, it's going to get worse. All right, so on to more bad news. the free cash flow for a business their size, it's not a great free cash flow number. The margin's 6%, profit margin 6%. So not good. Gross margins terrible. And again, some investors, I think psychologically, emotionally, Tesla's a technology company. I'm not going to argue the definition, but I just would want to differentiate. A technology company that makes an 80% margin is one thing. A technology company that makes 17% gross margins is a total different company. It's a low desirability company because the maximum you're going to make is 17% profit. Google makes 30% profits. Meta makes 35% profits. Those are the net profits. Meta's gross margin is 85%. Once they're done paying for all the whiz, engineers and talent that they have to hire, they're left with like 35% profit margins. That's a whole different ballgame. And that's why Tesla has a really low valuation in my book. Is I look at numbers. Stories are great. CEOs are paid to sell the vision of their companies. That's what they're supposed to do. I'm not arguing with that. They have cash of 36 billion, 13 billion of cash debt, So they have a good balance sheet. Let's look at the forecast that analysts are talking through. Look at this. Talk about a disagreement on valuations. You have one analyst that's at $19 per share and an analyst at 548. That is this is like the difference geographically from New York to Los Angeles. We are very, very divided in what this company is worth. And this is mainly on earnings per share. The revenue is supposed to recover, according to these analysts, in 26, which I don't agree with. I don't see where the growth is going to come from. Maybe they're expecting that. I don't know where the growth would be coming from Tesla. I guess the robo-taxi business is going to be a big hit and start producing lots of revenues. That's the only thing I can think of. Are you aware of any other businesses that Tesla's starting?
Just their robot Optimus.
Oh, okay. So they're going to sell robots for use cases, I guess, for industrial purposes, maybe security guards and stuff like that.
My wife wants one.
Yeah, well, we're going to maybe eventually be like the Jetsons, right? And the robot, you have one in the kitchen, can ask the robot to make you something delicious to eat. Okay, so on valuation for Tesla, as mentioned, it wasn't going to be pretty. It's just just the numbers. Okay. The numbers don't make sense. The numbers are in one side. And then the vision and so forth are completely in a different side. But, Elon Musk has a lot of credibility. He's done a lot of the things he said he was going to do. I get that. He's a rock star. Get that too. I just don't buy CEOs. I buy companies, and the fundamentals on Tesla, they look a lot like a car company. They keep being told they're not a car company. They're a tech company. Why do they sell so many darn cars? I don't get it. So I just stay out of Tesla. I just stay out of their way and, hey, go do what you're going to do, Tesla. I'm going to stay in Google Alphabet and Meta and Amazon and Alibaba and Uber. I'm going to stay with stocks that I get, and they have terrific numbers. In fact, Uber numbers are better than Tesla's numbers. And Uber doesn't have the revenue size that Tesla has, but they have higher cash flow, profitability, and their valuation's only like 200 billion. So I'd rather stick to Uber. So that's my evaluation on Tesla. Hopefully you found it interesting.
I can share my trade because this is purely a trade.
Go for it.
I've traded this since 2023. You can see that I've had a few losing trades, but overall I've made about 20% on this holding. I have a win rate of 74%. In my winning trades, I've made $1.05, and in my losing trades, I've lost $1. So on these 6, I've lost not quite half of my gains, but I had to trade a lot more for those wins. So that's why the gain loss ratio is low. But it's still a win rate of 74. And I'm in this with only 10 shares based on that cup and handle pattern, just to play this one for a short time.
Very interesting. So the market is pretty much flat. It's not doing much. It's a little green, which is good. And there's some winners and losers. Tesla being one of the big winners, probably the biggest cap winner. Amazon's up. Amazon's had kind of a rough week. It sold off quite a bit yesterday and the day before. Again, big banks are doing well today. Energy is doing well. A couple of software companies are catching a bid. A couple of semiconductor companies are doing well. Nvidia is up a little bit. So it's kind of a boring day. But I'll take boring. I'm sitting on big gains. I'm good with boring. All right, so we can press on, or we can call it. How you feeling? You got plenty of time, or?
Yeah, I have time. I don't have any more tickers to cover, but
I have 3 more ideas.
okay.
And I'll let you pick which one we go to next.
Okay.
The ideas are Intuit, Instacart, which is cart, C-A-R-T, and Amazon. Which should we go to first?
Okay. I own 2 of the 3, so let's go to Intuit first. I don't own that one.
All right. So Intuit. If you've done your taxes,
I have done my taxes.
And you use TurboTax, you used an Intuit product. It's probably what I like to think is their most recession-proof product, because recession or good economy, you're going to do your taxes. And they also do QuickBooks. They do Email Monkey, and they're a very, very well-run business. They're up 11% year to date, but more recently, they've had this sell-off, which created an opportunity. I ended up buying the stock and have been buying the stock because Intuit has been a little elusive for me. I've wanted to own Intuit. Intellectually, I'm like, come on, guys. I believe in your business. I like your business. And I always found that my capital was put to use elsewhere. And finally, I got an opportunity to buy them. But this has been a good company, good stock. They're $194 billion market cap. PE is high for this year. Forward PE looks like a 30, which is high. It's a strong buy with a discount, according to the analyst. Now, these guys, this is a model of growth right here. They're not, they just grow. That it's very, very impressive. Green all the way through. This is like the Costco of software. They just keep growing. And when we look at their gross profits, this is very desirable. 80% gross profits, 20% profit margin, 32% free cash flow margin. These are terrific numbers. Really, really well-run business. So I like the numbers. I think I like their balance sheet. They have $4.55 billion of cash and $6.6 billion of debt. Not a whole lot of debt. They have a debt to EBITDA ratio of 1.16. So balance sheet's in good shape. And Analysts believe, let's see, we got 18 analysts covering this stock, and they believe it's discounted by 16%. And the worst, price target that's out there is pretty much fair price, and everything else is above it. This is a quality business. You saw their growth rate, really well operated. I think their products are, let me see if I remember economic class correctly. It's inelastic, meaning you have a bad economy, no big deal. You move the price, they're going to keep buying it. TurboTax is such a cash cow for them. They just get people to buy into that service because it's no longer a piece of code you run. It's a software as a service experience on their website, and they keep your data. So the analysts believe the growth that has been kind of so impressive is just going to keep going. So I really like that. Profitability, keep going. So those things look really good. And I've got a valuation on them, so I'm going to show that, and then we'll go over the charts with Daryl. And Intuit is priced with a 4%, a whopping 4% discount. And I am buying shares of Intuit. I'm a dollar cost average investor. I don't own a lot of Intuit. So at a fair price, I buy it because this is a quality business that I want to be an owner in. Over time, I think it's just going to continue to amass more value. And just overall, their cash flows, it prices well. Based on earnings per share, prices well. And it's the 5% discount now. It's getting better. And, it's okay to pay a fair price on a great business, but it's not okay to get a great price on a fair company, because and I probably said that wrong. Warren Buffett says it better, but it's wise to, pick out companies that I want to own for the next 5-10 years, potentially, and just start accumulating those shares. I can have a couple of like shorter term investments that, hey, that company's just oversold. I want to own it for a year, 2 years, make some money. Okay, cool. But Intuit's going to be in a category where I could see myself owning this for the next 10 years. So that's my analysis on Intuit. What do you think of Intuit?
Yeah, I'm trying to figure out what's going on here recently. I presume this was earnings release.
They announced earnings on recently.
Yeah, and then probably on August 21st or 22nd. So they gapped up here, continued to trade higher, but they did eventually close that gap with their latest earnings report. This gap here was closed. So they are starting to move a bit higher. The 20-day is moving upward. The 200-day is upsloping. It had been downward sloping. Looks like it's moved back positive. It is trading below a downward sloping 50-day moving average. So let's see where that's actually sitting. The 50-day is at 714. And they're trading at 694. So that'll be a bit of resistance that it's going to have to navigate here shortly. The RSI did turn negative, looks like 2 days ago. PPO is still upward sloping, but in negative territory. The accumulation, there's actually been a little bit of distribution since the peak on around the July 29th. So with them being fairly priced, they might battle up to this 50-day, but I'm kind of expecting them to trade sideways for a little bit. That were my guess.
Yeah, it could be the case, and I'll be okay accumulating so long as Intuit continues to grow their top line and everything else stays the same, I'm good. It's the business keeps getting bigger and bigger and bigger, making more and more money. I'm good with that. All right. So Adobe is getting hit today, and this stock is really under pressure in 2025. Can you look at the charts on Adobe?
Sure. Yeah, it looks like they're down 3 1/3% this morning.
Mm-hmm.
Wonder how the other software stocks are doing. Is it only them, or is it software in general?
Some software stocks were going up, and obviously some are getting hit. Salesforce is up, ServiceNow is up, but Adobe is down substantially.
So they did break above a trend line, a negative trend line, for several days. So that was somewhat positive news, but it doesn't seem to last very long. They are trading below a downward sloping 50 and a downward sloping 20. The RSI is in more bearish territory, and the PPO is in positive territory. But if this kind of action continues, it's going to quickly be back in bearish territory below the midpoint. And they've seen a lot of decumulation over the past year.
So let me ask a couple of questions on the chart. So Adobe, I have a thesis that it's just really discounted, and it's unappreciated. Their sales growth is unappreciated. Their profitability is unappreciated. But the charts in the market just, doesn't really look at their valuation at this time. So what would you need to see in order to believe, okay, this thing's found its bottom and it's going to have a nice upward trend?
Over the past year, go back. It looks like the 344 area does have pretty good support. I see a touch point about right there, right there, right there, and right there. So it tests that pretty frequently over the last 2 or 3 years. So that looks like pretty good support to me. Yeah, it does look like good support. So as far as a bottom, I can't say it's a bottom, but they sure have good support here. So it looks like your downside risk is actually fairly low. If I draw a line across there and then go back to that downtrend line, they're really finding themselves trading in a wedge pattern. So I would keep an eye. Does it break above this pattern? If it falls below this pattern, then that 4-point support at this 344 level isn't going to hold. But we're coming up to a battle here, whether it's going to move higher or going to move lower. So
yeah, Mike, the dividend investor guy, he's part of the accumulation. All right, good. Yeah, we'll see. Stock investing, sometimes the market will zig when I think it should zag, and the market doesn't care what I think. It just does what it's going to do. And Adobe's been one of those stocks that I'm like, I don't get it. Maybe someday either the stock price is going to get to a level that I think it should be at, or the market's going to teach me a lesson, a long-term lesson. We'll see which one happens. So the next stock, it looks like ALAB. ALAB's been on a sell-off, and it's a really interesting semiconductor stock that had a really, really interesting chart, right? It's went up in 24, came down, and then it really went up. It just ripped higher from $55 a share, well past $200 a share. Now it's settling down at 206. It's really selling off with a little bit of energy to the sell side. I can understand investors taking some profits. I was selling. I sold a third of my position somewhere around here, just thinking, okay, I think the stock is overpriced, and I'm keeping the rest of the shares. It's just too good of a company not to be a part of it. This is a $34 billion market cap company. It doesn't have $1 billion of revenue. So you're paying, about 90 times revenue. Is that right? No, that's not right. You'd be paying, I don't know. I can't do the math this morning, but you're paying a lot for revenue. PE ratio is very high, 345. That's really high. And then forward PE is really high. Now, those numbers may make sense if you look at their growth. Their growth is just fantastic. Like, wow. Hang on to your hat, because it's going to fly off if you try to keep up with this company. It's really growing fast. It has high margins and high profits. So all those things look great. The valuation I have on ALAB it should still be priced too high. And looks like Google is not updating my lookups. And man, look at that. It's priced 42% too high. That's how fast it's run up. But I'm just going to sit tight. I'm not selling my shares. I did sell a third of my shares. So I'm kind of playing with the house's money. I really have my cost basis. If I were to decrement the capital I got back, I have no money invested in Astera, but I own like $40,000 of their stock. So I'm good just hanging on and being a spectator. And if the stock price continues to drop substantially, it's going to have to drop quite a bit, and then I will buy. Or I will wait for earnings to change their valuation and potentially buy again, or maybe even sell. But I think this stock is here to stay. What they do is a new category within semiconductor, which is you have data centers, right? You have an AWS data center, and a big company has a workload there, and they have a Google Cloud data center over here. You got a big workload there. Well, having those two communicate with one another is a very big necessity now. That's what Astera Labs does. It's data center to data center connectivity. And they do the best semiconductors for that. And I have to think that either they're going to get too big to acquire, or some other bigger company is going to want to take them and add them to their portfolio. They're at $34 billion in market cap. So it'd be a pretty substantial acquisition. But we've seen some pretty big ones in the last couple of years. So this one here wouldn't be all that crazy. I think when I think I've seen some bigger acquisitions in that. So we'll see. All right. What do you think about ALAB? What are you seeing on the charts?
Well, when you mentioned how much they were overvalued, I did a quick calc, and that'd be about the 200-day moving average, which is sitting at 111 at the moment, 112. And they have actually tested that as recently as July. And they must be a fairly new company, because their 200-day moving average finally started being calculated.
Yeah, they IPO'd about a year ago.
Yeah, so it takes 200 days for the first dot of the 200-day moving average to show up. So they've at least tested it once, and in March they had a sell off, and then everybody sold off in April. But many of the tech companies were selling off in February and March. But they do test that, so your valuation is saying it's overpriced by that amount, and the technical chart is saying that could possibly come back into play.
Yeah, and I think certain companies, it's one of the key steps in investing for me in my process is, do I believe in the business? Um, so the business that ALAB has, I most definitely believe in it. I'm like, man, they have a semiconductor that is a necessity now, and that is going to be a necessity for the next 5 years.
Yeah.
So I'm good with that. Looks like we've got a request on Wayfair, and then we've got, and absolutely, Lauren, if you want to put a super chat, we can look at a stock. We'll look at the charts, and we'll look at whatever else is out there for that stock, including evaluation. Thanks for tuning in. So let me show Wayfair, and Wayfair is a e-commerce company, and they, for a while, they were doing quite well, but this stock really sold off, and it's just been having a tough time. It's caught a nice rally because the stock price had been priced down, but look at that, really nice rally, very good. Year to date, 92%. Wow, looks really good. So this is $11 billion market cap. Revenue is $12 billion. Interesting. And what's their growth? See their growth, because I keep an eye on Wayfair, and this did not look pretty. These just constant kind of their revenues declining. But it looks like they are beginning to grow again. They probably have an assortment of products that is more sellable to their clientele. That looks good. When did they announce earnings? So they're coming up on announcing earnings next month. So investors are liking Wayfair. Let's see what they like. They have a little bit of growth now. They had some rough years. Their margin's 30%. They're not great because they're an e-tailer, right? They're trying to sell things that are priced appropriately and will sell, but they don't make a lot of money, and that tends to for the last couple of years they haven't had a profit. They had a profit way back here in 2020 when everybody was at home and needed furniture right away because they were going to spend more time at home. But ever since then, no profits, and free cash flow margin's been simply terrible. So not a really desirable business. If I look at, are these guys going to crank out money and cash and load up the balance sheet? The answer is no. Now, these guys have been around for a while. It's not like, hey, they're a startup. No, they've been around for a while. So they should know their niche and do it well. And they sell a lot of the stuff that I'm not a Wayfair customer, but from what I know, you can find it on Amazon. They don't have a big moat. They don't have a big competitive advantage. And when we look at their balance sheet has some debt. I don't know if it's terribly high. Debt to EBITDA. Wow. That's not good. Debt to EBITDA 29. My limit's 3. Going to 29. Why is this so high? Because they don't have any EBITDA. That's why. They're not making a lot of money. Their margins are so tight. How will they ever be able to pay off this debt? if we look at their cash flow, cash from operations in total is 388. So you can't devote all the cash from operations. You have to run the business, but it would take a while to pay off that debt. So this is uninvestable. I wouldn't touch it. Investors are probably buying this stock because it's recognizable, right? Oh, I know what Wayfair does. I can go to their website, check out their products. Seems like a good business to have. And so far, if you invested this year, you're doing quite well. And analysts, 25 of them cover the stock. They're in disagreement on what this stock ought to be priced at, because you have some price targets at 35, well below its current stock price, and then some price targets that are above the stock price. But on average, 18% too high. The stock has gone up quite a bit. It's expecting that they are going to grow. This is okay growth. I was going to say decent, but what would be an adjective below decent? It would be acceptable. It'd be acceptable since they were declining sales to have a positive number. But I showed you their profitability, and their profitability is not good. So this one here is, this is somebody else's investment, not mine. It's just the fundamentals are undesirable. Competition from Amazon is there for their category of products. I would be completely staying out of Wayfair. What are your thoughts on Wayfair?
Well, the chart since April looks fantastic, but I've never bought into Wayfair. This isn't my bag of tea, so to speak, but this has been a pretty impressive run over the last few months. They were pretty much in distribution for most of the year up until accumulation picked up, well, right around April 2nd when the tariff announcements come in, which they do sell products from outside the U.S., so I don't know why this price is running up like this. If they were less impacted by tariffs, but I think they are impacted by tariffs. I think they import most of their products. So this is really surprising to me, but it is trading above an upward sloping 50 and 20 or 50 and 200. It is testing the 200, and if today holds and the rest of the week holds above this 20, then it will be a successful test of the 20. So it has outperformed the S&P 500 by 34%, outperformed discretionary by 29%, home improvement industry, it's outperformed by 54%, and that industry overall has underperformed, and that's kind of what I would expect given the environment that we're in. So I don't have an explanation why it's running up like this. I'd be cautious with it, but the chart looks pretty good over the last few months.
Interesting. All right, so we're nearing the end. Just a couple last mentions, and then we'll close out the show. It looks like let me try to do these in order. So Qualcomm is near a 52-week high. Oh, really? Interesting. Well, that's good. And if you bought at the right times, you're doing well on Qualcomm. It's a stock that I own. I like Qualcomm. I like the valuation. I think it's discounted. It also pays a dividend. Not the biggest dividend in the world, but it's 2%. Good to see Qualcomm, do well. And their Snapdragon chip is really impressive. It's ending up in laptops. It's in many, many handheld, mobile phones. So looks interesting. And it looks like Pinterest is selling off. I will be buying shares of Pinterest today. I'm accumulating this stock. It's discounted. And just to kind of abbreviate my story on Pinterest, this is what I like about Pinterest. 80% margins, profit margins 49%, free cash flow margins at 26%, and the company is growing. What's there not to like about that? So, yeah, I'll buy Pinterest. I've made a lot of money on Meta. Pinterest is very desirable like Meta. It's just small, and they're growing. So at some point, the market's going to recognize it, or somebody's going to acquire them, I would think. So I'll buy more Pinterest today. And the last one before we hit the road is Dave. Dave is down. Now this stock is, boy, it's gone places, huh? And, it's an exciting business. It's still relatively small, and it's growing really well. It has a new financial services offering. So I'm not buying a lot of shares in Dave. I'm kind of cautiously an investor, small position. I just don't know their business well enough to be comfortable to put a lot of capital into them. I just like them a lot. I like the way they're doing things. I like the uniqueness of their proposition. I like all those things, but I'm not comfortable enough to put more capital into them. I'm just going to hold my small position in Dave. All right. So good to see you, Tim. Good to see you, Mike. All right, let's close the show out. Really good stream. Thanks so much, Daryl. Really appreciate you covering everything you cover and all the prep you did. What's going on with your channel?
The only thing I've done this week is published a video on Costco. If anybody's interested in seeing my thoughts before they move into earnings, I shared them there. I shared a little bit here, but I go into a little bit more detail in that video.
Excellent. And tomorrow afternoon, I think it's going to be at 1:45 Pacific. We're going to do a Costco earnings stream. We're going to analyze Costco fundamentally, charts, listen to the management team, talk about Costco maybe for 40, 45 minutes. And if you are a Costco investor interested in Costco, I think you're going to get your money's worth tomorrow. And look forward to it, because Costco is a really important business. And one thing they do certain things where I'm like, it doesn't make any sense to me, but their customer is so darn loyal. They sell little bars of gold, and they sell out. Like, people can't buy it. Sells out. Like, sells out. Now, I go to Costco and I get, like, you can't get, like, razor blades. Best deal ever is at Costco. Tube socks, athletic tube socks. Best deal ever, Costco. You kind of go to these categories. Then they sell gold bars. It's like, what? That didn't make any sense. Some appliances, you get the top quality appliances, you get tires, you get, it's a little bit of an eclectic mix, but it's good value. And these guys, I mean, they made their business work. They do it the way they do it. They're going to keep doing it the way they do it. Customers love them for it. And Lauren, we could do one more request, but if you could put the request out, I'd appreciate it. But, I've never been a Costco investor. And a part of it is that I probably lean into technology because I've worked in the industry. I've worked in technology businesses. I lean into higher margins. and stay away from lower margins. My closest investment is Kroger, which is a food retailer. And that's as close as I've gotten. But who knows? Maybe I'll become a Costco investor at some point. All right. So with that, looks like we're going to close out the show. And Lauren, if you want to put a request, you can email me. Just look up my email and put in a request, and I'll put it on the list for the next go around. Well, thanks again, Daryl. Everybody have a terrific day. Good luck with your investments, and really appreciate you tuning in. All right. We'll see you guys.